So what happened this week? I mean, we've had bad news in other weeks. Equities just kept climbing. This week, something happened. I mean, we had, as I say, record GDP growth. We had pretty good earnings coming in, and the interest rates are still near zero. What's going on?
Yeah, thanks, David. Look, I think this week we face a triple whammy of uncertainty. We still have this tremendous U.S. election coming up in less than 5 days now. We still have worrisome virus trends, not only here in the U.S., we're seeing it around the globe. And finally, we still don't have this fiscal stimulus package coming out of Congress. Keep in mind, volatility ahead of an election is not uncommon. We've seen that historically, and oftentimes that does resolve once you get a definitive election outcome. This year, we're also facing a dramatic 40% plus rise in the S&P and the NASDAQ after this March 23rd sell-off. So clearly, markets are taking a bit of a breather here. But over time, what we're seeing is that each of these walls of worries that we outlined can be resolved. So over time, we will get a definitive election outcome. We certainly will get some fiscal stimulus, likely not before Election Day, but certainly perhaps in the lame duck session and certainly early in the next term of whoever is president, really. And then finally, on the virus, keep in mind, we are facing a tougher winter, colder months ahead. But we also are facing, 2 or 3 phase 3 vaccine candidates that may provide some data, perhaps even end of November, early December. So maybe better news on that front as well in the weeks ahead. What we're saying generally is that we should use these periods of volatility, use these periods of consolidation, either to kind of diversify your risk if you haven't already, or maybe add to risk even if you haven't done that as well as we head into 2021.
So, Mona, as you know so well, it's hard to look at the equity markets without taking at least a peek over at the bond markets. And at the same time, the 10-year yield went back up. People were selling bonds, actually. The yield curve steepened this week. Is that indicating the bond market thinks actually good times are coming?
Yeah, it's interesting. I think the bond market performance may reflect what we may be seeing in terms of spending going forward. Keep in mind, as we mentioned, we'll probably get a sizable fiscal package. As the virus trends worsen, as the economy perhaps plateaus or stabilizes, that brings more pressure to Congress, that brings more pressure to the government overall to provide more stimulus. Now, we've heard from both candidates, in addition to stimulus, they plan on spending. So in the Biden case, he's outlined $7 trillion of areas of spending, including clean energy, including infrastructure, including areas of growth technology. Even in President Trump's case, we've heard infrastructure is on the table, and likely we will see a spending plan emerge from his team as well over time. So markets are certainly looking at what's happening in the next 6 to 12-month period. They're seeing stimulus coming. They're seeing spending coming. All of that puts upward pressure on yields as well. And at some point, it may put upward pressure on inflation as well, though we have not yet seen that come to fruition. But certainly the bond market's acting that way. And we even saw some stabilization in gold, which tends to be an inflation hedge as well.
So what does this tell an investor that they're supposed to do? I mean, there was a time we thought just go into tech, particularly big tech, you're safe. This week, tech led the way down, actually, in equities, not up. So what does that mean? Utilities actually were up this week. So what do you do as an investor?
Yeah, clearly we've seen this tremendous rise in big tech. The NASDAQ, as we noted earlier, is actually up close to 60% off that March 23rd low. There's a reason technology has worked so well, and that's because this more stay-at-home, more digital world really does benefit companies like Amazon, like the Apples of the world. But keep in mind, we've seen some trends really accelerate through this crisis. So the rise of going from brick and mortar to online retail, going from stay-at-home or going to stay-at-home using more cloud computing and cybersecurity, going from doing your medical visits in person to doing more telemedicine. All these trends have really been accelerated through the COVID crisis. They've also really been reflected in the stock market. But what we're seeing going forward, so the next 12 months may not look exactly like the last 12 months. We do think there'll be a broadening of participation beyond just these stay-at-home COVID winners, especially as we get a real true reopening story happening. So that could mean you get some of your cyclical value sectors also performing, like parts of financials, industrials, and energy. It could also mean you have some non-US players performing well as well. But keep in mind, there's certain sectors that we think could do well regardless of which side wins or what happens on election day. And that's areas like infrastructure, as we mentioned. Both parties have said they wanted to fund infrastructure. Clean energy and sustainability in general, that's a trend we see having legs regardless of who wins. And then U.S. housing and autos, we think, are still supported given the low rate trends. And then finally, growth areas of technology or secular growth areas that we call infrastructure plays as well. 5G falls into that category, certainly parts of AI and robotics as well. So what we're saying near term, that barbell approach between growth and value probably makes sense as the virus trends are worsening. Over time, make sure your portfolio is broadening a little bit to capture that reopening story, and some of these themes that we mentioned could work well in either scenario.
It's fascinating. In the meantime, in a nutshell, is everybody counting on the vaccine? Is it practical matter?
That's a great point. I think we need not only, a vaccine that's more than 50% efficacious, we need more than 50% of the population to take it, and then we need consumers to change their behavior as well.